Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite. She's the president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim. Happy June.
The equity markets, people keep talking about how high they are and how they're basically being supported by 10 companies led by the so-called FANGs. How dangerous of a situation is it to have people putting all their money into the equity markets? Pension funds are even in there.
Yeah, well, one of the things, we've talked about QE over the past few years several times. The world's, central bankers have issued trillions of dollars in this excess liquidity. If you ever ask yourself where that money's gone, it's not into the real economy. It's gone directly into financial assets. And so what you find is that, for example, I was just doing some review of some of this for our client letter at the end of May, and the explosion in things like passive funds and passive ETFs. Here's some stats for you. At the peak of the market in 2007, there was about $807 billion in ETFs, exchange-traded funds, these passive index products globally. And now there's about $4 trillion in 4,874 ETFs, a couple of thousand of them in the U.S. alone. In Canada, we had 25 TSX-listed ETFs for buyers to choose from 10 years ago, and now we've got about 465. So what we've had is this explosion of product offering, these fancy different packages of security funds, ETFs, anything that people can buy and call it investing. The problem is that if you look under the wrappers, what you've actually had is a decline in number of publicly traded companies in the past decade. So you've got less diversity now with all these, these different products really masking that. And so people are, there's been huge liquidity. It's gone straight into these things. It's partly to do with the way CEOs are compensated in the world today of publicly traded companies. The fact that it has been legal for them to issue debt and buy back shares since 1980, about 1982. It used to be considered illegal market manipulation back then for many, many years, and then they took away that constraint, and so people could just issue debt and buy shares. So what you've had is this massive surgence of capital flowing in. The problem is it's all in, right? There isn't the U.S. is now looking at ways to lower liquidity, to back out of QE, to reduce their balance sheet, to increase rates. They're trying to sop up a bit of this liquidity, just as the growth is about as weak as it's ever been. So you've got this crazy phenomenon of the second longest, expansion since the 1900s, the second longest market expansion, even though it's been in fits and starts. You've basically had markets go up in a straight V from 2010, and then you had sideways struggle till they started these QE things, and then you had finally a ramp in late 12 into 15, let's say. And the S&P in the last, few months on Trumphoria managed to make a new high. But if you look again under the wrappers, under the headlines about what's going on, you find that even these so-called broad indices, even if you're not trying to pick a sector-specific index or fund or ETF, and you're looking at a broad market, you think, oh, well, at least I'll get some diversity benefit there. It'll be less risky, less concentrated to, certain sectors. Well, actually, no, because when you look under the hood, you find that, for example, the S&P and the NASDAQ are firing on the FANG stocks, right? The Facebook, Apple, Amazon, these companies that everyone's basically fallen in love with in the hedge fund community and in the fund management community, because there's only so many stocks to pick from, and they've been under this deluge of liquidity coming in, so you have to put this money somewhere, right? So their mandates typically are long always. They're not allowed to hold cash for any period of time. Their maximum ETFs are fully invested, fully funded. No one's supposed to be, worrying about risk. Just mirror indexes and plow it into these things. And with fewer things to pick from, you've seen, the hot stocks, or the ones that are considered the most popular, go up to insane levels. So, in terms of valuations, we're talking about 70 times forward earnings and, just crazy multiples that we haven't seen since the tech peak in 2000 when we looked back, we all said, oh wow, that was a crazy time. Investors lost their mind and everyone was talking about the internet, and no one was worrying about whether or not there was viable business models. Well, the same thing has really happened in the past few years on this QE liquidity. So what you've got is this, people have been firing the so-called active managers and plowing money into passive equities because they're looking at the management fee saying this person's charging 2% to manage the fund, and they're not even they're matching or underperforming the index, so I might as well go over here and just buy the index myself. But what everyone's forgetting is that there's no one managing the risk in any of that. So yes, most managers aren't worth a fee because they just are long always plow your money in and don't ever hold cash for a rainy day, or don't ever try and scale back your exposure. They're just long always, that's it. So there isn't really any value in paying a fee for that, for sure. I mean, if you're going to do that, you might as well go for the low fee offer, put your money into an index or a passive ETF. But the problem there again is who's managing the risk around the equity cycle? The answer is nobody. So although you may think you're saving half a point, if whether you're in the long always fund or the ETF, if you're just fully strapped to the cycle at record peaks back at 2000 levels, and at the year 2000, the craziness that we saw then, we're seeing replicated now in just about every major valuation metric that we follow. So again, people have lost count of how you measure risk, about how much of their life savings should be exposed, about the fact that this is the longest cycle, second longest cycle ever, that valuations are very stretched, that they're, that they're that much older than they were in 2007, and they have, 9 years less time in their life now to face another major downturn and then have to wait years for it to recover. So no one's really managing risk, and those that are passively holding things today think that they've somehow got away with something, or else they're ignorant of cycles at all, which is often the case, and they just think you can, pick up nickels in front of a bulldozer and take your dividends and it'll all be great. That's just not the way it works. If you look at the Canadian market today, for example, the so-called broad TSX, Jim, what you see is that, not only is 67% of it concentrated in the financials and energy companies in Canada, but it is literally just about 1% above where it was in June of 2008. So it would just take a 1% decline here for it to have made zero money in the last 9 years. In terms of capital gains. So, and that's not the worst of it. The worst is, you've been holding all this risk, you've been enduring all this volatility, and you may say, well, I'm picking up 2 or 3% a year in dividends. That's great. But the reality is that can be given back in a heartbeat. And we've already seen that in, for example, the Canadian dividend, ETF as an example. The XDV is a share that people often buy for, it's got utilities and financials and the things that are considered so-called blue chip, low risk, income paying dividend stocks, right? So what you find is that it is now down 8% since February the 1st, and its yield, it's already lost 2 years of the income it was paying in just the past 4 months. So you cannot just buy these things thinking you're somehow outperforming a GIC without any recognition of the fact that you're incredibly risk exposed. In this sector in general, in equities in general, they're volatile and dangerous. But when you're at secular peaks in valuations, when you're at the end of this extremely QE extended upcycle, the risk is off the charts. The capital risk is off the charts. And we saw these so-called conservative instruments drop 45% plus in both of the last two downturns. And that's very typical of what you see when you're coming out of, as I say, these very contrived, extended, overvalued, overbought periods. So same with the U.S. financial sector is another interesting one. You know, it popped quickly on the Trump-phoria as he got elected in November, and now it's given all that back and is, you know, actually down year to date. So you really can't, you know, forget anything about valuation and just buy to look busy. It's a catastrophic, you know, it looks really bright to be long and not paying any fees and, you know, riding the thing up, and then it looks absolutely suicidal on the way down.
We'll have more with Danielle Park right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're chatting with Danielle Park. Danielle, Toronto, I'm hearing now that perhaps they've reached the peak of the real estate market there, where homeowners who bought in this spring are now looking at ways to try to get out of the deals because they're realizing they paid too much.
Well, I think I definitely follow several Toronto realtors and sort of real-time reporting on the street in this area. For sure, they are talking about some people losing heart, realizing on sober reflection the next day or the next week that, hey, we really, you know, overstretched and committed to pay more than we can actually afford. And they are, in some cases, walking away from the deposit and just saying, you know, no thanks. So I do think that there's, you know, as we saw in Vancouver, Jim, frankly, when your laws changed, that you had a major downturn in sales volume for a period of time. I think it was a 40% decline in your sales volume year over year as the new legislation and rules started to kick in. And we're starting to see numbers like that coming out of the GTA area, not just Toronto, but the surrounding environs, including north towards Barrie, where I live. We're seeing a cooling in the market. However, there still seems to be a good deal of transactions taking place. What I'm gathering anecdotally from some of my friends in the business is that, you know, properties are still selling, but they're not going for, you know, over ask. They're going for maybe at ask. So this could be the leading edge of it. Typically, volume of sales is the leading edge and a precursor to lower prices. And what was, I think, really remarkable is, you know, a few months ago, when things were still at a fevered pitch, there was all this talk about no supply anywhere, right? And this is classic. You hear people saying there's no supply, so prices can never go down. You know, that's why prices are only going up. Well, lo and behold, you know, there's nothing like crazy prices to bring new supply onto the market. And I think the listings jumped 50% in May over the year or over April. So yeah, you can really find product fast when people realize that they're being paid, you know, that their house may have doubled in value in the past 3 years. A lot of people, and this is a demographic trend which I've been talking about for some time as well, is this the bulk of the property owners that have the most expensive, you know, dwellings in the country are in that boomer 53 to 71 age bracket, and they're all sort of, you know, if they're not empty nesters, they are soon to be empty nesters, and they're looking at their savings and how little it's able to to produce an income these days, thanks to, low yields, both on fixed income and on equities and the risk there. And they're saying, geez, we're going to need to raise some more cash or lower expenses. There's two ways to become more wealthy. One is to make more, and one is to need more in terms of what you're need less in terms of what you're spending. And so that's really, I think, where people are focusing. So I think that the trend towards more supply is going to continue. I think that there's a lot of people who have been sitting on properties, even multiple properties, who are starting to think, geez, why do we need all this, for upkeep, time to sort of get simpler and leaner and enjoy our time more than just be groundskeepers and, be house poor. So, I think we're certainly overdue. If you look at any of the historical archives from, last peak in real estate in Ontario, for sure, was in the late 1980s. And if you read any of the, accounts and papers, they were saying all the same things that they've been saying in the last year here, about there being insatiable demand and not enough product, and, buyers have nothing to pick from and all that. And then all of a sudden, lo and behold, there's a deluge of sellers, and buyers start to retreat and realize that, hey, wait a minute, why is everyone trying to sell here? And you get the same kind of thing. It's like the stock market. It's very similar. When people have really become emotionally involved in, just funneling money into something because they believe it's only going to go higher, there comes a point where it's like the Wile E. Coyote, where you run right off the cliff and then you freeze and say, oh no, now what? And everyone starts dropping together and trying to get liquidity and trying to sell and trying to get out. And it's because they were ignoring all the warning signs and valuations and math-based assessments leading up to that. That's how a bubble built from those characteristics, and it's also why a bubble bursts. Same emotional kind of, gut response that got them in wants to get people out. And then there's a cash flow crunch typically, and that's very, very much the case with real estate because it is actually a negative carry, right? If it's not going up in value, if you're just keeping it as a place to live or as a so-called investment, then you are actually paying to maintain the property, so it isn't paying you. And, a recent Manulife survey found that 60% of people's net worth in Canada is actually in their house, as their primary residence is actually where 60% of their net savings or net equity is. So again, if you're approaching, your later years retiring and you're thinking about, wow, how can I get enough money to live? One of the first things you're going to think about is how do I lower my expenses and how do I raise some cash here?
We'll have more with Danielle Park right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Danielle Park. Danielle, the auto sector, I've heard, is in for some massive changes. Millennials don't feel it's necessary to own a car. They're fine with using transit or car share or calling a cab. They don't see it's necessary to have a status symbol made out of chrome and steel.
Well, when you think about it, it's actually a highly inefficient way to move around. First of all, to have, thousands of tons of steel to move a human body one or two at a time is actually a very inefficient use of energy, right? The most efficient use of energy is to get on a bicycle. If you think about that in terms of output for distant travel, a bicycle is very efficient. And then if you try and, oh yeah, but that's not that practical because of weather and not everyone wants to be riding around a bicycle all the time, the next thing you start thinking about is what are other more cost-effective, efficient modes of transportation. And that's where we get to this whole revelation about, if we're not going to keep adding crazy amounts of consumer debt to households, which I would argue we've got to be at the end of that, appetite, both on, again, because incomes have not expanded with the debt. So we are now at the very end of that tether in terms of being able to take on more debt payments or finance costs. And that's typically how people have been buying these vehicles. And lo and behold, Jim, you find that in April, all the world's largest car manufacturers in Western Europe, China, U.S., they all noted a synchronous contraction in sales in the first quarter of 2017 into April. That's the first time that's happened since the 2009 recession. So we know that the sales that have been made in the past few years have been on the back of, more and more aggressive incentives from the dealers and more, trying to entice people in, making it, cheaper or easier anyway, to get into a brand new vehicle than it is to even buy a used vehicle. And in Canada, the average auto loan now is at something like 74 months, or it was in 2015. I think it's even longer now. And 25% of those borrowers were non-prime, paying interest rates of up to 25%. That's what the Bank of Canada's numbers suggest. So you have to realize that there must be a point here where people can no longer afford to keep buying these vehicles. And indeed, we're seeing that in the inventory numbers. The channel stuffing and the amount of vehicles that the manufacturers are trying to download onto their dealer distribution network is the highest, again, it's been since the last peak in recession. So I think it's coming at, there's a few things at play here. I think it's the aging demographic who's, again, wanting to downsize. It's the younger demographic who's broke and carrying student debt thanks to extreme rises in the cost of education and housing over the past few years. So they are literally having to get smarter because the cash flow is just not there to cover all the payments. And at the same time, you have this world waking up to this really more efficient technology in the transportation area. So whether that be, the Ubers of the world, which are making it so easy to come and go on shared transportation, whether it be, the highly cost-efficient rail and rail systems and bus systems. People are just, whether it's the shared biking, shared cars you can pick up and drop off in different locations. This whole revelation that we can get a lot smarter with how we share this resource and how we meet our own transportation needs is not going away. And, whether or not the Americans pull out of the Paris Accord, I think the reality here is that the world knows this is a huge business area that is coming, exactly at the time that the world needs to do more with less, that people have no more ability to add debt or appetite to do so, and this push to get more efficient and smart, to have less congestion in cities, to have better air quality. All these things are really coming to a perfect point right now. And so it's a pretty exciting thing because, if you're wasting less cash flow on some of these other things, you're going to have more cash flow for other things like that will actually improve your quality of life, help you get out of debt, help the economy to have savings again. I noticed that the recent data on the Canadian savings came out this morning at 4.3% is Canada's savings rate currently, and that's just historically too low. That's not going to provide enough cushion for a rainy day or for any of the future needs that people are going to have, let alone to be able to scale back work and retire someday. So I think that getting efficient is a huge part of that, and that means less vehicles. Now, that's also going to be a challenge for the economy because, as you remember, no doubt, in the 2008 recession, one of the big programs they came out with was to try and get, when the housing bubble burst in the U.S. and the U.S. economy went into recession and most of the other countries followed, one of the big things they were trying to reignite was this appetite for buying big ticket items, and so they did, cash for clunkers and various programs to get people just to take these off the lot, no doubt they'll try that again, but I think that they'll be less successful. Also, the age of the vehicle fleet in North America is younger now, thanks to all these past few years of adding all these brand new cars on 6, 7, 8 year leases. So people are still paying that off, and they don't have any need to replace their vehicle anytime soon. So that's going to be a headwind for the economy, because right now our economy still, gets the bulk of its sales from these big ticket items. The bulk of something like 94% of Canadian growth now is estimated to have come from housing construction in the past, 6 years. And that's a problem, because if we're at the end of the appetite to keep doing that, and if we've run out of people who haven't bought a house yet or who can afford to buy houses still, then we have a lull coming in an already slow growth expansion in the world. And now we're going to be left with the reality of aging demographics and too high debt levels. So that's going to be our lot for a while here, and I think that the next phase is going to be the connection, the reconnection between that reality in the real economy and the bubbles that we've seen in all these financial assets, which, as I say, have been this, the QE funnel into those products has had this big disconnect between what's really going on in the world and what's going on in financial markets. The fact is, though, that money is already in. And once it's already in, there's nothing to do but for it to go the other way, because there's no new $4 trillion of buying that's going to just show up any day here. And people are going to want to sell those assets once they start to mean revert. So that's going to create, I think, a great opportunity for those who have not been sucked in, who have, maintained some personal discipline, retained some liquidity, built up their savings, paid down their debt. I think they're going to get a great opportunity, but it's going to be unfortunately when most of the people that are in today are losing their shirt and running for cover.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.